2025 is in the books. It's time to look forward to 2026. To start, I want to talk about my 2025 and two things that made my year. First one being fading the inflation and recession fears from April. Now, every stock was down. That was probably the biggest alpha I provided on Substack, and nobody basically read it. This is because only 10% of consumer spending is tied to imports. Everyone wants to talk about what about intermediate goods? That's in that number, okay? 70% is services. So if you want to talk about, oh, well, lots of things have to go into goods, okay, that is 10%. So if you have 20% inflation hike on that, that's 20 bips. What are we talking about? 5% UMISH? Okay, what are we talking about? And, there's the more controversial point that when you increase the price of something, if you don't increase the wallet size, it's not inflationary. We talk about the one-time price increase. I think that's pretty standard. But when it comes to the economic theory behind inflation, it is really about a growing money supply, right? That's where the smartest people that I follow all stand behind. So if you increase the price of rent, they're going to have less money for vacation. If you increase the price for goods, and the majority of imports, quite frankly, in terms of dollar numbers, are luxury goods, besides if you exclude China. So it's just like very ridiculous, and that was the biggest macro edge I could have possibly wished for in a year, besides 2020 with a massive quantitative easing, which somehow everyone missed. So that led me to be bullish throughout the year. It just did. And I'm bullish going into 2026 for different reasons. But my best call of any stock was Coherent. Adding $15 billion of market cap. It's like that's not even alpha compared to a massive macro trade, but I did nail this one. On TikTok, I was long Coherent at $50. Everyone was panicking. I remember being on live, people were saying, no, everything's going to go. No, we were good. But then by $70, people were like, okay, well, we're not dead. We're not dead. And I was like, okay, coherent. And yet nobody listened. It was only until right before earnings, I was like, I'm kind of looking for a pullback. You guys can read my Substack, Mispriced Assets. I posted before earnings. I was like, kind of looking for a pullback here. It's charged right up. It's gone only straight up since April. What did we get? 25% down. Now, did I expect that? No, I did not expect that. And then I was like, it's time to get dirty. Pound the table at $89. It went like a little bit below $89, and then it just ripped straight up. And basically the thesis is these optical components, the transceivers, Coherent's got a pretty diversified optical as well as industrial lasers portfolio. But I was like, this is so important for the AI trade. It is not talked about at all. And then what you have seen is Coherent go basically straight up. Now, Lumentum has actually outperformed Coherent this year. I think that switches into 2026. Reason being is that Coherent has a better manufacturing ramp. So they have basically the same market cap, but Coherent has twice the datacom revenue and basically the same amount of total revenue that Lumentum has in industrial lasers that I also think will rebound. Why? The big beautiful bill. Excuse me, I'm confused my B's. Big beautiful bill. You can amortize stuff in year one, whether it's a factory or it's R&D. The factories that we're going to bring back are more the high revenue businesses where you can have higher wages, and these lasers go for $250K a pop, $500,000 a pop. And some of them, what Coherent's really good at on the industrial side is doing it in a modular way and customizable so that it can go on a robotic arm. Now, IPG is great, Trump is great. They're not like the clear winner in that category, but I think they're the clear winner when it comes to the hardware of optics because they have the best manufacturing ramp. There's a question, is Lumentum's alternating mirrors better than Coherent's liquid crystal? Quite frankly, I am not smart enough to tell you that, but I am smart enough to tell you that in a shortage, it doesn't matter if there's a 5-10% difference in tech. What is going to matter is, can the demand be satisfied? Coherent has 2-year contracts. They're like, their demand, just like Micron, is out further than it's ever been on indium phosphide, on basically everything. They're going to double ramp on indium phosphide next year, and supposedly Jim Anderson is saying he's pretty conservative, but the year after that. So we have a guy who 10x lattice semiconductor, and most of that was driven by yield optimization, AKA ramping manufacturing. So this is the guy I want to bet on in this race. You've seen memory take off. I still like Micron. I still like, the GPU trade. I like the TPU trade in the beginning until Vera Rubin comes out. AI is on. But I like networking, specifically optics, the most. And I think that Coherent has the chance to be up 70 to 100% in 2026 with, right now it's a 33 forward PE, the most limited downside you're going to get in AI. I want to highlight another trade. This was probably my best call. I hate saying that because I like the Coherent call better. But this was just called to a T, and it completely played out. Was saying that BTU was going to back out of the Anglo deal, and then rare earths were going to be a story about it. It went from 2.5 EV to EBITDA, and it doubled. So it went to 5.5 EV to EBITDA. That's literally what I called, 4 to 5 EV to EBITDA. Re-rate in coal, because Trump likes coal. We need rare earths, and it is too damn cheap. They're walking away from a bad deal. So I just wanted to highlight that. Let's go to JAKK. I'm going to skip forward here. This is probably, on timing alone, one of my worst calls, because I figured it's not going to be that bad in Q3. It was that bad. Everyone that was going to order, this is a toy company. They make Disney princesses. They make Sega, Sonic stuff. Toy company, Christmas. Target, all of those retailers were so scared about the changing dynamics and tariffs that they just didn't really order. And then they didn't get that early pre-sale. So therefore, they were like, we don't really know what to buy. We're not going to buy much. We're just going to hike up the prices of everything and try to sell other stuff. Well, that didn't really help JAKK out. It was pretty much the worst year you could have possibly asked for any toy company. JAKK specifically did not do well, but management remained conservative. I thought the market was going to be like, this isn't so bad, 2026. It wasn't like that. It was as bad as people thought. And I was like, that's really bad. But notice the stock, it flash sold off. I told everyone $2 of downside, $17 of upside. Still think there's now $18 of upside. It's only down 75 cents since when I was like, buy it. Not financial advice. But it flashed down to 15.50. And there were some people that sold there. It was down there for 15 minutes. And then it's been above the downside the whole time. It's down 75 cents. People have been paid 25 cents. Per quarter, you get paid 25 cents in dividends. This stock, I love going to 2026. I'm calling it the year of JAKK. I think it's going to go to 35, $3 of EPS in 2026. Basically, a bounce back to 2024. But the market's got to be looking forward to 27 because these guys have a lot of things in the pipe. They have opportunities because they played this so conservatively, and a lot of people are struggling to make deals. I really like the diversified portfolio. They're not Mattel. They're not Hasbro. They don't own the IP, but they have deals with all of the IP owners, basically, that you would want. And they'll continue to do that. And going into 2026 Christmas, which I do think is going to be a strong economy, so therefore a strong holiday season, JAKK should be 35. And you wait 12 months, you get paid 5% dividend, over 5% dividend, nearly 6%, and then you get a double appreciation on the stock price appreciating as well. This is a sort of story that I think could be ultimately a BBW, a Build-A-Bear workshop, and really sort of kick into gear, going to the 50s, the 60s, and beyond. However, my chip shot on this stock is taken for 12 to 14 months and riding it for 100% plus the dividend. I think that is one of the stronger ideas I have going into this year. It just takes patience. A lot of people don't have patience, and we learned that. Oh boy, do we learn that. Another stock, Xnet. So this is a very interesting story. There's Xnet and then there's JFIN, my two Chinese small cap names. I could add more if I wanted to, but I'm just saying, two Chinese names are all I need. Chinese small caps are so underpriced for the most part. You can look at Baba, you can look at Baidu, you can look at JD and say how underpriced they are. This company is trading at 1/3 book value. People didn't even know that this app, honestly, I didn't even know. I didn't even know because I was investing on this business for it to go to $10 when it was at $4 because I like the business itself, growing 40% year over year, 49% gross margins. They're like a data center business, but mostly for video streaming. So I like the business. The business is really cheap itself. And then all of a sudden, out of nowhere, oh, by the way, they own 8% of Arashi Vision, a company that IPO'd in China and is like one of their best performing IPOs. And that stake is worth $1.2 billion. Now the market cap here is under 400 million. So when they realize that the lockup is in June, this stock should at least double, probably triples. It's the clearest example of a mispricing I could ever see. Like, fine market, you want to discount that 40%? Like, do what you want. The $7 price going into 2026 is maybe my best idea. It depends on timing because like there's some stories that might ride longer and in 2 years would be a 5x. But as, in terms of a 6 month, give it a little more time, 7-8 month trade, Xnet is just ridiculous. Xnet is ridiculous. Look into it. I love this stock. Again, mispriced assets has more details in all of this. And then JFIN is the other one. Look how ugly this chart is. Oof, that's an ugly chart. The thing is, like, people are like, oh, well, technicals don't look good. I want to, see until it starts looking better. It's like, brothers and sisters, this is under 1x earning, under 1x free cash flow. Like, I get it if you're talking about Lululemon and it's like, well, just crossed the 200-day. I think maybe it's going to have a flush out, this and that. It's like, yeah, you might be able to save a turn or two on Lululemon. There's no more turns left on JFIN, on any multiple. No more turns. It would have to be 0. Like, this is a time to buy at 580. And I think that it's going to ride to 15, 17. And here's the thing. They're making so much money. Their dividend last year was $1. So you're getting over nearly 20% dividends on last year's earnings, and earnings is up 40%. So maybe it's going to go up another 20 cents over the year prior. So it's $1.20, over 20% in dividend. Are you going to get paid? And the bear thesis is all a wash. Like, it's hogwash. Regulatory chain is, sell everything fintech in China. It's like, okay, well, listen, like, I understand they have some high yield loans. This doesn't affect their loan. Like, they don't have a loan book. They're a volume player. They're just finding loans. So like, arguably, if instead of 24%, you're at 20%, there's going to be more volume because consumers are going to want credit more at that level. And I don't think credit dries up because you're just like, you can't lend more than 20%. Like, that's a little ridiculous, isn't it? Like, a consumer personal loan can only be 20%. Well, banks aren't going to take 20%. It's just a little aggressive. This Chinese small cap should kick into gear, specifically fintech. I think all of China, especially in the beginning half of the year, is going to be good. JFIN, Xnet, my best two China ideas. Then rail. I already drew this up because I was like, guys, it's breaking out. And I was like, train is leaving the station. It's kind of leaving the station. Yeah, you can see the breakout. This stock is like, one of those US stocks that like people just don't really pay attention to until the stock is like ripping. It's now consolidating a little bit at 11. I think it goes to 17. So a little bit of the move is behind, but they make rail cars. They make rail cars for an industrial boom because of the big, beautiful bill. And that's like a leading indicator, right? Like, that's the cheapest way to transport materials. If you're building out these massive data centers, you have to get stuff there. When it comes to coal, going back to BTU, needs to be transported by rail. It's the only economical way. Like, you don't have pipelines. even oil gets transported on rail. So they make rail cars. Last quarter was spectacular, like 30% growth. Their backlog is the longest that it's ever been again. So this is a company that's probably going to earn, somewhere like $1.50 to $2 in EPS in 2026. And for a US company, that's far too cheap. I think it could be even higher than that $2 range. I'm being pretty conservative with that. So they've made their balance sheet much better. There is some debt, there is some warrants. I don't care. This stock is a great stock. I've traded it really, really well from 4 to 17, took profit, told everyone on TikTok. Then, started adding it back probably a little bit too early, like around here. And then it's basically just gone straight in my favor. And I was really pounding the table at like 950. So missed a little bit of the run, but hey, this is a great stock, and it is an industrial play. It is a small cap. It's not correlated to the AI train. I don't think you want to be over your skis on AI. Like, that's kind of basically what I'm saying. So highlighted right there, 5 stocks I still love. Coherent, BTU might get back in there, but it's not in that 5 stocks. Xnet, JFIN, Rail, and JAKK. 4 small caps, micro caps, honestly, and 1 AI play that I think is good enough to take the whole tailwind. Now, you can distribute, and you can get Micron, you can get Avgo, you can get Google, you could get NVIDIA, TSM, whatever you want. I think Coherent should be in a AI portfolio. It should be in a portfolio. So as you got some mid-cap exposure there, and by the way, Coherent, if it doubles again, is probably going to the S&P and getting another leg of wind. But the small caps games, I think maybe it's a small picking environment in 2026 for small caps. And that's a very dangerous thing to say because every time you think that, you get hurt in small caps. But I think you want to own just look through, because not a lot of smart people are looking at these businesses. That's why I write about mispriced assets. Because, with my 115 IQ these days, I can outperform there, I can outperform there pretty good. Anyway, thanks for watching the video. I don't know where you're coming from. You can expect more YouTube videos going forward, and I wish everyone a very happy new year.